In 2008, 465 banks collapsed and millions lost everything. But what's coming in 2026 will make that look like a practice run. And if your money is sitting in one of these banks right now, you need to hear this before it's too late. Look, I know you've heard the warnings before. I know you're tired of the doom and gloom. But this time, it's different. And I'm going to show you exactly why the next bank collapse isn't just coming, it's already been set in motion. And the scariest part? Most people have no idea it's happening right under their noses. Why 2026? Why not now? Why not later? And the answer is actually terrifyingly simple. It all comes down to three converging factors that are creating the perfect storm. And when I show you these three things, you're going to understand why every major investor, every hedge fund manager, and every billionaire is quietly preparing for what's about to happen. Factor number one, the commercial real estate time bomb. Right now, there is over $1.5 trillion in commercial real estate debt that's coming due between now and 2026. And here's the problem. These loans were made when interest rates were near zero, when office buildings were full, when retail spaces actually had customers walking through the doors. But that world is gone. Remote work destroyed the office market. E-commerce devastated retail. And now property owners are facing a nightmare scenario. They need to refinance these massive loans, but the interest rates have tripled or quadrupled. The buildings are worth half of what they were. And the banks? The banks are stuck holding these toxic assets on their balance sheets. Let me give you a real example. There's an office building in San Francisco that was valued at $300 million in 2019. It just sold for $60 million. That's an 80% loss. And this isn't an isolated case. This is happening in every major city across America. New York, Chicago, Los Angeles, Houston. The commercial real estate market is in free fall, and guess who's holding all of these bad loans? Your local and regional banks. The big banks, the JP Morgans and the Bank of Americas, they saw this coming and started dumping their commercial real estate exposure years ago. But the smaller banks, they're drowning in it. And when these loans start defaulting in 2026, these banks won't have the capital to survive. Factor number two, the unrealized losses sitting on bank balance sheets. Now this is where it gets really disturbing. Because of an accounting trick, banks don't have to report losses on their bond holdings until they actually sell those bonds. They can pretend everything is fine even when it's not. Here's what happened. During the pandemic, when interest rates were at historic lows, banks bought hundreds of billions of dollars worth of government bonds and mortgage-backed securities. Safe investments, right? Except there was one massive problem. When interest rates go up, the value of these bonds goes down. It's basic math. So when the Federal Reserve started raising rates in 2022, all of those safe bonds that banks were holding suddenly lost massive amounts of value. We're talking about over $600 billion in unrealized losses across the banking system. That's money that's already gone, but the banks don't have to admit it yet. Think about that for a second. $600 billion? That's more than the entire GDP of Sweden. That's more than the market cap of Tesla and Netflix combined. And it's just sitting there on bank balance sheets like a ticking time bomb waiting to explode. And here's the kicker. These losses are concentrated in the same regional banks that are also drowning in bad commercial real estate loans. It's a double whammy. They're getting crushed from both sides. And when depositors start to realize this, when people start to understand that their bank is technically insolvent, that's when the panic begins. We already saw a preview of this in 2023 with Silicon Valley Bank and First Republic. Those banks failed almost overnight once depositors realized what was happening. Billions of dollars withdrawn in a matter of hours. The FDIC had to step in and arrange emergency takeovers, and those were just two banks. Imagine what happens when dozens or hundreds of regional banks face the same crisis simultaneously in 2026. Factor number three, the derivatives crisis that nobody's talking about. This is the part that keeps me up at night. Because derivatives are the weapons of mass financial destruction that caused the 2008 crisis. And right now, there are over $600 trillion worth of derivatives floating around the global financial system. Let me put that number in perspective. The entire global economy is about $100 trillion. The derivatives market is 6 times larger than the entire world economy. These are basically bets on top of bets on top of bets. And they're all interconnected. When one major player fails, it creates a cascade effect that can bring down the entire system. It's like a house of cards built on quicksand during an earthquake. And here's what's terrifying. Many of these derivatives are tied to interest rates and real estate values, the exact two things that are about to blow up in 2026. When commercial real estate starts defaulting and interest rates remain elevated, these derivative contracts are going to start failing. And when they fail, the counterparty risk becomes systemic. What does that mean in plain English? It means that when Bank A can't pay Bank B on their derivative contract, Bank B might not be able to pay Bank C, and suddenly you have a contagion that spreads through the entire financial system faster than COVID spread through a cruise ship. Now, I know what some of you are thinking, but wait, didn't we fix all of this after 2008? Didn't Dodd-Frank and all those regulations prevent this from happening again? And that's exactly what they want you to believe. But the truth is, the regulations have been quietly rolled back. The banks lobbied hard and got most of the restrictions removed. And the new regulations that did stay in place, they only apply to the big banks. The regional banks, the ones that are about to fail, they're exempt from most of the safety requirements. Let me show you exactly what's happening right now behind the scenes. The FDIC, the agency that's supposed to protect your deposits, they're already preparing for mass bank failures. How do I know this? Because they just approved a special assessment on banks to replenish their deposit insurance fund. Why would they need to do that unless they're expecting to use that money very soon? They're literally preparing the lifeboat while telling everyone the ship is unsinkable, and it gets worse. The Federal Reserve has quietly reactivated something called the Bank Term Funding Program. This is an emergency lending facility that they created during the 2023 banking crisis, and the fact that they're keeping it active tells you everything you need to know. They know what's coming. They're just not telling you. Meanwhile, if you look at what the insiders are doing, the picture becomes crystal clear. Bank executives have been selling their own stock at record levels. We're talking about billions of dollars worth of insider selling at major financial institutions. These are the people who have access to the real numbers, the real data about what's happening inside these banks, and they're running for the exits. When the captain starts putting on a life jacket, you don't ask questions. You do the same. But here's where it gets even more sinister. The government and the Federal Reserve are in an impossible position. They can't let the banks fail because that would create a systemic collapse. But they also can't bail them out like they did in 2008 because the political backlash would be catastrophic. People are still angry about the last bailout. Occupy Wall Street might look like a picnic compared to what would happen if they tried to bail out the banks again. So what's their solution? Inflation. They're going to print money and inflate away the problem. They'll call it quantitative easing or emergency liquidity measures or whatever fancy term makes it sound responsible. But make no mistake, what they're really doing is devaluing your savings to save the banking system. Think about it. If your bank is holding bonds that have lost 40% of their value, and the Fed comes in and buys those bonds at face value, who's paying for that loss? You are, through inflation, through the decreased purchasing power of every dollar you've saved. It's the most insidious tax ever created because most people don't even realize it's happening. They just notice that their groceries cost more, their rent went up, their car payment is higher, but they don't connect the dots back to the banking crisis and the money printing that is being used to paper over the problem. Now let me tell you which banks are most at risk. And pay attention here because this is crucial. The banks in the most danger are the regional banks with heavy exposure to commercial real estate and with a large percentage of uninsured deposits. What are uninsured deposits? That's any money above the $250,000 FDIC limit. Here's the thing. Small depositors, people with a few thousand or even a few hundred thousand in the bank, they're generally protected by FDIC insurance. But businesses, wealthy individuals, anyone with more than $250K in a single account, they're not covered beyond that limit. And these are the people who will run first when they sense trouble. We saw this with Silicon Valley Bank. About 94% of their deposits were uninsured. When word got out that the bank was in trouble, those depositors pulled their money out so fast it made your head spin. $42 billion withdrawn in a single day. The bank went from solvent to bankrupt in less than 24 hours. So, which banks should you be worried about? Look for regional banks in markets with declining commercial real estate values. Banks in cities where remote work has devastated the office market. San Francisco, Seattle, Portland, New York, Chicago. These are the danger zones. Also look at the bank's loan portfolio. If they have heavy concentration in commercial real estate, that's a red flag. If they have a high percentage of uninsured deposits, that's another red flag. And if they're sitting on large unrealized losses in their securities portfolio, that's strike 3. I'm not going to name specific banks in this video because that could trigger the exact panic we're trying to prepare for. But if you go to your bank's website and look at their latest quarterly earnings report, all of this information is public. You can see exactly what they're holding and how exposed they are. But here's the real question. What do you do about it? How do you protect yourself when the system is rigged against you? How do you make sure your life savings doesn't disappear when the collapse comes? First, understand the FDIC insurance limits. $250,000 per depositor, per insured bank, per ownership category. If you have more than that in a single bank, you're at risk. The solution is simple. Spread your money across multiple banks. If you have $500,000, don't put it all in one institution. Split it between 2 or 3 different banks. And make sure they're actually different banks, not just different branches of the same bank. That doesn't help you. Second, consider moving some of your cash out of the banking system entirely. I know this sounds extreme, but hear me out. We're living in a time where the traditional banking system might not be the safest place for your money. So where else can you put it? Physical assets. Gold and silver have been stores of value for thousands of years. When banks fail, when currencies collapse, when governments print money into oblivion, precious metals hold their value. You can't print gold. You can't create silver out of thin air. It has intrinsic value that exists independent of any government or financial institution. Now, I'm not saying put everything into gold. That's not smart either. But having 10 to 20% of your wealth in physical precious metals that you personally control, that's not crazy. That's prudent. That's what smart money has been doing for centuries. Third, look at treasury bills and treasury money market funds. These are backed by the full faith and credit of the US government. And while I have my concerns about government debt, the reality is that treasuries are still safer than deposits in a regional bank. The government can print money to pay off treasury bonds. A regional bank in Iowa can't do that. You can buy treasury bills directly through Treasury Direct, the government's own website, or you can invest in treasury money market funds through any major brokerage. These funds invest exclusively in short-term government securities, and they are much safer than keeping large amounts of cash in a bank. Fourth, and this is important, keep some cash on hand. Physical cash. Not a lot, but enough to cover a few weeks or months of expenses. Why? Because when a banking crisis hits, ATMs stop working. Credit cards get declined. The electronic payment system can freeze up. We saw this in Cyprus in 2013. We saw it in Greece in 2015. We saw it in Lebanon in 2019. When banks fail, people can't access their money. Even if it's FDIC insured, even if it's technically safe, there's a lag time. It might take days or weeks for the FDIC to sort everything out and give you access to your funds. During that time, you need cash to buy groceries, gas, medicine, whatever you need. I'm not talking about hoarding millions of dollars under your mattress, but having a few thousand in small bills hidden securely in your home, that's just basic preparedness. It's the same logic as having a fire extinguisher or first aid kit. You hope you never need it, but you'll be really glad you have it if you do. Fifth, diversify internationally. This is something most Americans never think about, but it's actually really important. Having all of your assets in U.S. banks, denominated in U.S. dollars, tied to the U.S. financial system, that's concentration risk. You're putting all your eggs in one basket. Consider opening a bank account in a foreign country with a stronger banking system. Switzerland, Singapore, Norway. These countries have much stricter banking regulations and much healthier financial systems than the United States. Yes, it takes some effort to set up. Yes, you have to report it to the IRS, but having even a small percentage of your wealth outside the US banking system can be a literal lifesaver if things go south. Sixth, and this is controversial, but I'm going to say it anyway, look at cryptocurrency. Now, before you roll your eyes and click away, hear me out. I'm not telling you to go all in on some random meme coin. I'm talking about Bitcoin and maybe Ethereum. These are decentralized digital assets that exist outside the traditional banking system. When you own Bitcoin, you don't need a bank to hold it. You don't need permission from any institution to use it. You don't have to worry about your account being frozen or your bank failing. You control it directly through your private keys. And in a world where the banking system is on the verge of collapse, that kind of independence has real value. Again, I'm not saying put everything in crypto. That would be reckless. But having 5 or 10% of your portfolio in Bitcoin held in a secure hardware wallet that you control, that's a reasonable hedge against banking system failure, especially for younger people who have time to weather the volatility. Now let's talk about what happens when the crisis actually hits. Because it's one thing to prepare beforehand, but you also need to know how to react in the moment when things start falling apart. The first sign will be news reports about a major regional bank in trouble. It'll probably start with rumors on financial Twitter or Bloomberg. Then it'll hit mainstream news. The bank's stock will start plummeting. Within hours, maybe even minutes, depositors will start trying to withdraw their money. This is when you need to act fast. Not panic, but act decisively. If you have money in a bank that's showing signs of distress, get it out immediately. Don't wait to see what happens. Don't hope for the best. Move your money to a safer institution or convert it to treasury bills or physical assets. I know this sounds alarmist. I know it sounds like I'm fear-mongering. But remember what happened with Silicon Valley Bank. People who waited even a few hours lost access to their funds. People who acted immediately got their money out safely. Speed matters in a bank run. The second phase will be contagion. Once one major bank fails, depositors at other similar banks will get nervous. They'll start pulling their money out too. And this creates a self-fulfilling prophecy. Even healthy banks can fail if enough depositors demand their money back all at once. This is when the government will step in with emergency measures. They'll probably announce something over a weekend when markets are closed. They might raise FDIC insurance limits temporarily. They might arrange shotgun mergers between failing banks and stronger banks. They might activate emergency lending facilities to provide liquidity to struggling institutions. Pay very close attention to these announcements because they'll tell you how bad things really are. If the government is taking emergency action, that means the crisis is serious. Don't let the reassuring words fool you. When officials go on TV and say the banking system is sound and your deposits are safe, well, that's usually when you should be most concerned. The third phase will be the policy response. And this is where things get really interesting or really scary depending on your perspective. The Federal Reserve will have to make a choice. Do they let the banks fail and risk a complete systemic collapse? Or do they print money and bail out the system, risking massive inflation? My prediction, based on history and incentives, is that they'll choose inflation. They'll print. They'll bail out the system. Because central bankers and politicians fear deflation and depression more than they fear inflation. They think they can control inflation. They know they can't control a deflationary spiral. So expect massive quantitative easing. Expect emergency lending programs. Expect the Fed's balance sheet to explode. And expect the value of the dollar to decline as a result. This is actually where the real wealth destruction happens. Not from the bank failures themselves, but from the monetary response to the bank failures. Your deposits might be safe in nominal terms. The FDIC will make you whole. You'll still have your $100,000 or whatever, but that $100,000 won't buy what it used to buy. Groceries will cost more. Rent will be higher. Gas will be expensive. Your standard of living will decline even though your bank balance stayed the same. This is why owning hard assets becomes so important during these crises. Gold, silver, real estate, even stocks in good companies. These things tend to maintain their real value when currencies are being debased. They rise in nominal terms to reflect the declining purchasing power of the currency. Now, I want to address something that I know a lot of you are thinking. Can't the government just prevent all of this? Can't they step in before it gets bad and fix the problems? And the answer is theoretically yes, but practically no. Here's why. The problems I've described, the commercial real estate crisis, the unrealized losses on bank balance sheets, the derivatives time bomb, these aren't problems that can be fixed with a simple policy change. They're structural issues that have been building for years. They're the result of a decade plus of zero interest rate policy and quantitative easing. They're the consequences of blowing massive bubbles in asset prices and then having to raise rates to fight inflation. You can't undo that overnight. The Fed can't wave a magic wand and make commercial real estate valuable again. They can't make those bond losses disappear. All they can do is try to manage the crisis when it happens and minimize the damage. And frankly, their track record on this isn't great. They didn't see the 2008 crisis coming, even though the warning signs were obvious in hindsight. They didn't prevent the dot-com bubble or the housing bubble or any of the other financial crises of the past few decades. They're always reactive, never proactive. So no, don't count on the government or the Federal Reserve to save you. You need to save yourself. You need to take personal responsibility for protecting your wealth and your financial future. Let me give you a concrete action plan, something you can implement today, this week, to position yourself for what's coming. Step 1. Audit your banking situation. Write down every bank account you have, how much is in each one, and whether you're over the FDIC insurance limits. If you're over the limits at any institution, make a plan to move that excess money to another bank or into treasuries. Step 2. Research your bank's financial health. Go to their website, pull up their latest quarterly report, and look at 3 things: their commercial real estate exposure, their unrealized securities losses, and their percentage of uninsured deposits. If any of these numbers look scary, consider moving your money to a more conservative institution. Step 3. Set up accounts at multiple banks. Don't put all your eggs in one basket. Even if you don't move money immediately, having accounts already established at other banks means you can transfer funds quickly if you need to. When a crisis hits, you don't want to be trying to open new accounts while everyone else is doing the same thing. Step 4. Buy some physical precious metals, even just a few ounces of gold or a roll of silver coins, something tangible that you can hold in your hand, something that has value independent of any bank or government. Store it securely at home or in a private vault, not in a bank-safe deposit box. Step 5. Build a cash cushion. Take out enough physical currency to cover 1 to 3 months of expenses. Keep it somewhere safe at home. Don't tell people you have it. This is your emergency fund for when the electronic payment system goes down. Step 6. Open a Treasury Direct account and start buying short-term Treasury bills. These are incredibly safe, and they pay decent interest right now. Much safer than leaving large amounts in a regional bank. Step 7. Consider opening a brokerage account at a major firm like Fidelity, Schwab, or Vanguard. These companies have much stronger balance sheets than regional banks. And your investments are protected by SIPC insurance separate from FDIC. You can park cash in Treasury money market funds while you decide what to do with it long term. Step 8. Educate yourself. Read books about previous financial crises. Study what happened in 2008, what happened during the Great Depression, what happened in other countries that experienced banking crises. History doesn't repeat, but it rhymes. The patterns are there if you know where to look. Step 9. Talk to your family. Make sure your spouse, your parents, your adult children understand what's coming and what they need to do to protect themselves. You can't save everyone, but you can at least warn the people you care about. Step 10. Stay informed, but don't obsess. Check financial news regularly, but don't let it consume your life. There's a balance between being prepared and being paranoid. You want to be ready for the crisis without letting the fear of the crisis ruin your quality of life today. Now, I know some of you are thinking this all sounds too extreme, that I'm overreacting, that the banking system has survived for this long, and it'll keep surviving. And maybe you're right. Maybe 2026 will come and go and nothing catastrophic will happen. Maybe the banks will muddle through. Maybe the commercial real estate crisis will resolve itself somehow. Maybe I'm wrong, but here's the thing. The cost of being wrong, if you prepare, is minimal. You'll have some gold coins sitting in a drawer. You'll have cash in a safe. You'll have your money spread across a few different banks instead of just one. Big deal. That doesn't hurt you. But the cost of being wrong, if you don't prepare, could be catastrophic. You could lose access to your life savings. You could watch your purchasing power evaporate. You could be standing in line at an ATM that isn't working, unable to buy groceries for your family. So from a pure risk-reward perspective, preparing is the rational choice. It's like buying insurance. You hope you never need it, but you're really glad you have it when disaster strikes. And look, I'm not some doomsday prepper living in a bunker waiting for the apocalypse. I'm a regular person who studies markets and economics and pays attention to patterns. And the pattern I'm seeing right now is the exact same pattern that preceded every major banking crisis in history. Excess debt, asset bubbles, rising interest rates, unrealized losses. These are the ingredients for disaster, and they're all present in the system right now. The question isn't whether a crisis is coming. The question is when and how bad. And based on everything I've researched, based on all the data I've analyzed, my best estimate is that 2026 is when things start to break. That's when the commercial real estate loans come due. That's when the refinancing crisis hits full force. That's when the banks run out of room to hide their losses. Could it happen sooner? Absolutely. Could it be delayed until 2027 or 2028? Possibly. But the direction is clear. The outcome is inevitable. The only variable is timing. So use this time wisely. Don't wait until the crisis is already happening and everyone is panicking. Do it now while you still can, while the system is still functioning normally. If you found this video valuable, if it opened your eyes to what's really happening in the banking system, do me a favor. Share it with someone you care about. Send it to your family members, your friends, your coworkers. Help spread this information to people who need to hear it. And if you haven't already, subscribe to this channel and hit the notification bell, because I'm going to continue covering this crisis as it develops. I'm going to keep you updated on the latest developments, the warning signs to watch for, and the steps you need to take to stay ahead of the curve. Leave a comment below and let me know what you think. Do you believe the banking crisis is coming? Have you already started preparing? What steps are you taking to protect your wealth? I read every comment and I love hearing from you.